Really worried about tonight's stream. I mean, everything that could go wrong has been going wrong. So I would appreciate a thumbs up if you can hear and see me, because I have absolutely zero confidence. I'm probably talking to a camera that's turned off. Yeah, it's been one of those days. I even lost the speed chess game I play every Monday night at 6:50. Tells me if the stream's going to be good or not. I lost on time. All right. Well, thumbs up. That's good. I had to restart my computer. The camera didn't want to work. So real quick, for those who are watching this after the live is over, you're watching it tomorrow or whatever, there will be timestamps below the video. I usually get them up with the help with some help later tonight or tomorrow. The reason I mention that is I've got some administrative things that I need to cover tonight before we actually get to all the fun stuff. The first is this. So let me move my water bottle. So I've got a new microphone. Here it is. Not that you care. It's off at the moment. Okay. The one I'm actually using is up here. It's a shotgun mic. Not that it really matters. And what I want to do is test this, and you tell me how it compares. And I'm going to do a couple of polls tonight. So let me see if I can get this working. All right. So I'm going to put the poll in here. Don't answer the poll yet, because it's going to be which microphone is best, but I haven't tested them yet. I'm just going to get the question ready. Which mic is best? And the answers are going to be the one you can't see, the one in front of my face. Okay, so the one you're hearing now is the one in front of my face. I mean, boy, that's going to confuse everyone. The one you're hearing now is the one you can't see. All right. Now, can you hear this one? First of all, can you hear it at all? Can someone give me a thumbs up? Test 1, 2, 3. Check, check, check. Anybody? Buzz? It's louder. Yeah, that makes sense. And all right. I can bring it down on my end. Of course, you might have volume control on your end as well. Anyway, so this is the mic in front of me. This is the mic you can't see. The mic you can't see is probably not as sensitive. So I tend to turn it up more. And this is the one you can see, which maybe I don't need to turn it up as much. My question to you is, which one sounds better? There you go. I'm currently using the one in front of me. I don't know if that matters for the poll, but that would be a big help to me. While you're answering that question, I'm going to continue to use this one for the moment, pending the outcome of the poll. Until then, I want to show you a few things. Okay, here we go. This is the first thing. So I was at a conference, I guess, about a week ago, and folks from the crowd were there. Daniel and and Laddie, excuse me. They were great. There's a picture of us. I'd just given a talk up on the big stage. And this is a personal finance blogger or YouTuber, TikToker, podcaster kind of conference. And yeah, it was great to meet them. They're working on early retirement, a lot of fun, which also brings up another topic. So I'll be speaking I'm on a panel at the Bogleheads conference in Chicago, October 12th to the 14th. If you're going to be there, what I'd like to do on Wednesday night, because Thursday night there's like a dinner, but Wednesday night we're sort of on our own for dinner. And so for those that are there, I'd love to get dinner with you guys, either at a hotel, restaurant, or somewhere close by. So if you're going to be at the Bogleheads conference and you're interested in hanging out with me Wednesday night, shoot me an email. I'd like to at least get a sense of, I don't know how many people are going to show up. I know I've gotten some emails from folks that will be there. So Noreen says, I chose the one we can see, but there's a bit of raspy sound to it. I'm going to pull it down a little bit on my end. And so maybe that helps a little bit. I don't know. When I do a pre-recorded video, I have more, I can do some editing to the sound post-production. Sounds pretty fancy. So I'll keep using this, but I don't know, continue to give me feedback. At least for the poll, let's see here. How do I look at this? I don't want to end the poll. Here we go. 87% prefer the one in front of my face. That's pretty strong. So by the way, so I did a video on direct indexing. I spent a ton of time on that video, both the content, but then the editing, and people just hated it. I don't think they hated the content, but I did all this fancy editing, had this background music, which apparently is a thing. Actually, the thing that I think bothered folks the most was the background music. So I've 86'd that. That was an experiment I was trying, but man, you guys beat me down. You were not happy. So that's out. I still like a little bit of editing. What folks didn't like was sort of the chopping. I guess you guys just prefer for me to hit record and start talking. And if I mess up, that's okay with you guys for the most part. I will say tight editing does condense it a bit because I tend to ramble. I'm sure you haven't noticed, but I've been told that. Anyway, yeah, you guys look, even Noreen, I mean, she's supposed to be on my side. She's throwing me under the bus. She didn't say I don't like the background or I prefer not. She says, I can't stand background music. That seems fairly definitive. All right. Well, that actually makes my life easier because that's just one less thing I have to do. All right. I'm going to end the poll. It's at 88%. So that's good. I do have a few more things I want to cover. First of all, so my mom, she is an author. She writes children's books. I think I've mentioned this before. Here's one. So Anastasia is the main character. It's actually a character patterned after a cousin who passed away many years ago. But great books. Anastasia meets Jackie Robinson. So a lot of her books have some sort of historical perspective. There's one, let's see. Yeah. Anastasia and Amal visit Lady Liberty. So there's history about the Statue of Liberty. So great books, great for gifts. I'm just promoting my mom. These are excellent books. Apparently, I don't know if my mom ran into or a friend of a friend, but somehow connected with my second grade teacher, Mrs. Mackey. And I have a vivid memory. I can remember in the hallway which side the classroom was on and where my first grade classroom was. I have vivid memories of kindergarten and preschool. And the thing I remember, by the way, Mrs. Mackey might be watching tonight. Now, this would have been 47 years ago, and apparently she remembers me. Now, I don't know, that may be a bad thing. Or maybe she just never seen a kid with a head as large as mine, and that just sort of, impressed on her. I don't know, some sort of visual, oh yeah, that kid. I remember, though, going into second grade, I was called Robbie. Well, there was another Robbie in the class, and she made me change my nickname to Rob. I was heartbroken, but I got over it. That's okay. What doesn't kill you makes you stronger. All right, what else do I have? I think that's just about it. Oh, one other thing. So, I've mentioned SaveBetter in the past because they have really good interest rates. But, it's not like putting money directly into a bank. It's a SaveBetter platform. The money goes to a bank, but it's a little different. So some people love it, some people don't. But I got this comment that really bothered me. And it was from, not the commenter, but I was like, I read this, I'm like, from Vibes Alive 45. I called the FDIC and they essentially said the SaveBetter Sallie Mae 2.7 no penalty CD is not FDIC insured. So my first thought was, what do you mean they essentially said it? I mean, see, this is the lawyer in me. It's either FDIC insured or it's not. But because they pool funds, so it won't be in your name if SaveBetter goes under. She basically said there's a similar company that just went under. and I couldn't give me the name, but said, quote, "Be careful." So I appreciated the comment, but I didn't believe it was factually correct. But I mean, they're saying they called the FDIC. It's not exactly like I've got any better information on FDIC insurance than the FDIC. So I called them this morning, the FDIC. They open at 8. Called them up, 8:05, and they answered. It was like a little phone tree, but within 60 seconds, I'm talking to a real live person. And I tell them, SaveBetter, blah, 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 is at FDIC insured. You need to call back. You need to speak to a subject matter expert. And they don't come in until 8:30. I guess the call center's live at 8. But the SMEs, I guess, I don't know. Maybe it's a union thing. Not sure. They don't have to come until 8:30. So at 8:45, I call the FDIC. And here's what I'm expecting. They transfer me to the subject matter expert. Gentleman answers the phone very quick. I mean, like I said, just 60 seconds, I'm talking to someone. And I'm thinking ahead of time, well, I'm going to have to explain what SaveBetter is. I guess give them the URL, kind of explain how it works, all that. So I say to him, calling about SaveBetter and our deposits through SaveBetter FDIC insured. He goes, yep, they sure are. And I'm thinking, I know you're a subject matter expert, but that seemed a little too quick. And then he adds, yeah, we're familiar with SaveBetter. Yeah, they sure are. Now, he pointed out, he goes, SaveBetter itself is not FDIC insured. He says, but that's because we insure deposits. See, he's getting technical. Like if you said, well, Citibank is FDIC insured, that's actually not correct. It's a member, FDIC member. You'll see that logo on their website and all bank websites that are a member of FDIC, but it's actually the deposits that get insured. And I know what you're thinking, Rob, that's kind of lawyerly technical. Well, that's just how it works. And he pointed that out. He goes, yeah, but they're to pooled account, they're FDIC insured. Now, I'm not trying to push SaveBetter. In fact, my last cash went to Treasury bills. I did have a SaveBetter no penalty CD as well, but my last one was Treasury bills. So, do whatever you feel comfortable with. But I do think it's important when you make your decision to have the facts. So feel free to call the FDIC yourself if it's of interest to you. Yeah, they answered pretty quick. All right. I'm sure I'm forgetting something in terms of the administrative things. I do have one other poll I want to ask you, and then we'll get into it. Would you be interested in, I'll call it what do I want to call this? I'll call it a paid community. The idea is, here's the deal. I get tons and tons and tons and tons of hundreds of emails a week, not to mention thousands of comments. And trying to keep up with it all is pretty much impossible. And so what I'm thinking is, should I start a community where we can hang out and we can ask questions there and we can help each other, share information. Obviously, I would be a big part of it in terms of trying to help people. I don't know if I'm going to do it. It's just a question, but it would have to involve some kind of payment. I mean, some kind of, there's costs and time. And so you might not even be interested, but I'll say yes. For discussion, for chat only. So it's just a chat, like a Discord or something, like for chat only. And I'm going to guess, I don't know what the cost would be. I'll just say, I haven't even thought about it really, but I'll just say that would cost $25 a month. And then yes, for chat plus a bunch of other stuff. What would that be? I could put courses in there. I could do series on the 4% rule, asset allocation, investing 101. That would obviously be something I'd build up over time. I could do live streams in this community, so bring on guests. And I don't know what that would cost, but I'll just put 50 as a round number. And then I'll add one more option that says no. I'd just be curious what you guys, what you think. And why won't it let me ask this? Must contain between 1 and 35 characters. Oh, chat. Okay. Plus, I really am getting to the show. Plus other stuff. There it is. Okay. I don't know if those are the only two options, but that's just what I'm going to do for this poll. And then give me your honest reaction to that. All right. So the topic for tonight, I just kind of wanted some ideas. I've gotten some emails on CD ladders. And that's what kind of got me thinking the yield curve. Oh, by the way, if I did any sort of community, it wouldn't affect the newsletter. It wouldn't affect the YouTube channel at all. But in any event, on DC ladder, CD ladders and that sort of thing. And that's what kind of got me thinking about the yield curve. And I'll show you what I mean by that in a minute. But if you think about a CD ladder, the idea behind it, and you could ladder bonds. Really, I almost like to think of it as a fixed income ladder, where you want to have. We'll just use CDs as an example. You want to have generally the higher rates of longer term CDs, but you don't want your money locked away for, let's say, 5 years, subject to having to incur a penalty to get it out. So one way to think about a CD ladder is you'd start off and you'd buy a 1, 2, 3, 4, and 5 year CD. When the 1 year matures, you would roll it into a 5 year. When the 2 year matures, you'd roll that into a 5 year, and so on. What you end up with are a series of 5 year CDs, and one of them is maturing every year. So you're getting the benefit of longer term yields on longer term CDs, but you're also getting penalty-free access to your money. In this case, once a year. You could set it up so that they would mature every 6 months or whatever. But when you have an inverted yield curve, it kind of throws a monkey wrench into the whole thing. And let me show you what I mean. So let's see here. Well, this is not the best chart, but it'll do. So here's the U.S. government bonds yield curve. You'll notice for short term, it goes straight up and then basically flatlines and even goes down as we get longer term, all the way out to 30 years. That's not a normal yield curve. Normally, you would expect the yield to gradually go up as maturities, lengthen. That would sort of be a normal yield curve. This one is, they call it inverted. You can see, for example, the 2 year, I think this data is roughly correct. I don't know if it's been updated today, but we'll call it 4%, 3.9443, according to this website. And if we go to the 10 year, they often compare the 2s and the 10s. It's lower. So the first question is, well, what's up with that? Why? And it's because the market is expecting effectively a recession. They're expecting, there's inflation now. They're expecting the Fed to raise rates, and therefore they're demanding higher yields on shorter term investments. But they're expecting that what the Fed will end up doing is pushing us into a recession. And so demand will go down, unemployment will go up. That'll bring inflation down, but again, put us into a recession. So how will the Fed react to that? They'll start lowering interest rates. Some say maybe the end of next year. Again, who knows, right? But that's sort of the theory behind it. That's sort of what the market is expecting. And so that's why longer term, we actually have lower yields, right? And that presents an interesting, I think, puzzle on if you have cash you want to invest now, or you've got, your bond portfolio, how do you play that? It's like when let me show you back to here. When a 1 year is paying 4%, boy, it's awfully hard to put your money in a 30 year at 3.5, or even, I don't know, a 10 year. But here's actually where the longer terms could be a better investment, right? Because yes, for the next year or two, you'd get higher yields. But if the market is correct and yields and rates end up going down, this 10 year at 3.5% right now, or even, who knows, the 30 year at 3.5, could end up being quite valuable if rates, remember, as rates go down, the value of bonds go up. And you could apply this. We can look, let's see, it's CDs. So I'm on Fidelity's website. You can see the CD row is here. Now here, the rates all go up as we get longer term, but boy, not by much. Look, the 1 year is 4%, 5 years, 25 basis points more. It's like, wow, do I want to lock my money away for 5 years just for an extra 25 basis points? That just seems like, not a great deal. But again, this, if we imagine a year from now, a year and a half from now, 5-year rates are back down to 2%. And of course, the shorter term rates are much lower too. Boy, you would have loved to have locked in 4.25% at 5 years. And all of that kind of gets us back to this question of even bond investing. I've gotten a lot of questions about, should I sell my bond? Should I buy back in? What do we do? And my general approach has always been not to invest based on what I think interest rates will do, because I've just found that I'm not very good at predicting it. And so oddly enough, you could still do a standard CD ladder, even with extending out 3, 4, or 5 years, even though it may not look like a good deal, because what the market is effectively saying is interest rates will come back down. Now you could say, well, but the market could be wrong. Yeah, the market's always wrong. But if you want to invest in a standard, in a, I'll call it, without predicting future interest rates, I just have a bond portfolio. I don't ever change it. In my case, it's usually something like BND. I think intermediate treasuries are a really good option as well. BND includes intermediate treasuries, but it includes other things like investment grade corporate bonds and some mortgage bonds. But either one would be good. And I just sort of stick to it. I'm not changing it based on what the current rate is or where I think interest rates are going. And if I were interested in some sort of bond or CD ladder, I'd probably create it just like I always do, even though, as we saw, yields are kind of crazy right now, because I'm not confident in my ability to predict future interest rates such that I'm willing to take a significant bet, one way or another. Whew, how's the poll going? What happened to the poll? Oh, wow, you guys don't want me to do this, do you? Okay, well, that's good to know. So 81, it's interesting that 81% said no. Well, I guess what that would mean is you're not interested in that. 8% said the other stuff. I'm in the poll, the $50. I put a number in there just to, I don't know what it would be, but just to put a number in there. 11% said for the chat only. Okay, I appreciate it. I don't know if I'm going to do it. Life is pretty good right now. I mean, I do these videos, play chess. All right, enough chit chat. Let's get to your questions as best I can. I kind of feel like I'm out of shape here on this. I've missed the last 2 weeks. Oh, yeah, last week I had a minor family emergency. I say I'll be, Monday night, 7 p.m., Lord willing, and the creek don't rise. Well, it rose last week, but everything's good. I had a fracture, an ankle issue that I had to help someone with. And it came up at like 20 till 7. All right. Tom, let's see here. Let's see what Tom has to say. I have a Roth IRA and 401k. I contribute 7% Roth, 3% traditional to my 401k. So I guess you have both a Roth and a traditional 401k. That's how I read that. And my Fidelity rewards, I guess maybe from a credit card, from the Fidelity Visa, go to the IRA. Does it make sense to go 8% traditional? Oh, no, maybe not. Maybe it's 7% goes to the Roth IRA and 3% to the 401k, maybe. Does it make sense to go 8% traditional and increase my Roth IRA contributions? It's kind of a difficult question, Tom, for me to respond to in a vacuum. I guess my first question would be, do you get an employer match? Be question one on your 401k. Because for me, I would want to take full advantage of that to begin with. That would be step one. That would take precedence over the IRA, get your full match. Once you do that, I like, there's different ways. It's not like you have to do it this way, but I kind of like then funding the Roth IRA because you have control of it. You've opened it up wherever you think is best. And so, you can invest in pretty much whatever you want. Although again, your 401k investing options may be great. But beyond that, the question would then be, how close are you to maxing them out? Because I guess ultimately that was my goal, was to max out my IRA and 401k back in the day when I was contributing. I will contribute to a SEP IRA this year in any event. Those would be sort of how I'd think through it. I'd also think about HSAs if you have a high deductible health insurance policy and funding that because of the triple tax benefits of an HSA. And obviously you might have other goals, right? Buying a home, saving for a child's education. So, we're very much looking at this sort of in a vacuum, but those would be sort of the questions that come to mind that I'd be asking. All right. So let me ask you this. Can you guys hear this? Let me see if I can. Nope, not working. Never mind. You're the first person. Good job with the new format on yesterday's direct indexing video. Very professional. You're the first person to compliment it. Well, that's not true. Certainly the music, the background music, I don't think one person liked it. I do like some of the graphic elements, which I think should help it. Oh, you heard the applause. Funny, I can't hear it. All right. Well, yeah. See, I'm getting fancy on you. But I appreciate it. I'm going to stick with some of the graphical elements. Like I like the timestamps coming up so people know what to expect on the video. I'm probably going to try to limit the cuts in the video. I mean, it's one thing when I go from you guys looking at me to, looking at the computer. So that's obviously a transition. But I'm going to try to avoid the cuts, even though it does tighten the video up a little bit. Kind of gives it a different vibe, and I'm not so sure I like it. All right. Omar, welcome to the show. Oh, here we go. See here, Jay Davis. Hope Rob addresses the last video he uploaded. The background music was atrocious. I think what you meant to say was the background music wasn't to my liking. No, I guess atrocious. Yeah, that's probably what you meant. Yeah. I don't know if it's just background music in general, or I'm just not good at picking music and getting the level correct. Maybe one of the problems is when I listen to these before I publish them, I'm just listening to it on my computer speakers. I need to pull it up on my TV and send it through the surround sound. Maybe then I'd be like, that's awful. Oh, this is funny. R. Hasten says, I've watched a bunch of Rob's videos and I'm still not filthy rich. Quite upsetting. I don't know. You got to put them into practice. Or maybe it's the videos. All right. So Jeff, I did cover CD ladders, but if you have more questions, let me know. All right. I think, by the way, I'm still going to not use this for the pre-recorded videos, but I think I am going to try to invest in a more higher. I have a pretty decent shotgun mic, but maybe a little higher quality. This is an interesting question from Elad. Is there an app that will send me an alert if I spend with a particular merchant, like, for example, Amazon, and it's close to exceeding some threshold, maybe that you set for yourself? Or will it stop the charge from going through without my approval? That I don't know. There are certainly apps that can tell you when a budget category is about to be exceeded, although it's not a feature I've used, so I don't know off the top of my head that I could direct you to what I think might be the best option. And you'd have to continue, you'd have to, I'm trying to think how that would work. One of them that I have on my phone, and I have a lot of them on my phone just because I like to test them out. But one of them, somewhere on here, where is it? I guess I have to search for it. It's actually a pretty good, I wonder if I took it off my phone. That's interesting. It's called Truebill. I think that's the name of it. It's interesting. It's not on my phone. Yeah, I must have taken it off. I actually like it. The app is designed to keep you informed of all the subscriptions you have, and they can help you unsubscribe. And they can, I think in theory, they can negotiate deals for you, like at Verizon or whatever. I've not used those services, but as a budgeting app, I kind of like it. And I know it can send you alerts. I don't know how much you can fine tune it to a specific merchant. So I think in the end, I'm not much help on that question. All right. All right. I'm getting through all of your comments about the mic. Appreciate that you did that for me, because clearly I don't have an ear for any of this. All right. People mentioned clipping. I think that's a penalty in football, right? Block in the back. That's what we used to call it, clipping. Do they still call it that? Did you see the Ohio State game? They scored like 1,000 points. It was against the University of Toledo. Their quarterback, phenomenal, actually. They scored, I think, 21 points. It's impressive coming into the shoe, and I had to give Toledo a lot of credit. So Steve says, what about healthcare in early retirement? Nobody ever mentions that. Well, I mean, it depends on your situation. I mean, a lot of folks, because of the Affordable Care Act, we can all pretty much buy, putting aside whether you qualify for any subsidies, we can all, buy health insurance, directly or on the exchange. And I think that's how, for the folks that I know who've retired early, and really it's anyone right before 65 for Medicare, right? That's what they do. Some actually, and I think this is a part of the system that I don't think is all that great. You can be a quadrillionaire, but if you don't have any income, I guess if you had a lot of money, it was in taxable accounts, you'd generate taxable income. But you can have $1 million in the bank and still get free health care if it's not generating income. And some early retirees do that. By the way, if you do that, I'm not saying you shouldn't. I just don't like the way that was aspect of it was set up. But in any event, I don't know why I went off on that. Yeah, that's what most people do. In our case, we buy it through our business. But in effect, it's, there are some differences between buying it as an individual and buying it as a business. In my experience, if you can buy it through, if you're consulting, you've got a business, and the rules vary from state to state. Another thing I find frustrating, you'll get better deals with a business policy than you will, I'll call it a consumer policy. But I think that's what most early retirees do. Just buy it, directly, or through through healthcare.gov. I like this. Chadwick says the above 65 crowd likes the mic, the one that's in front. That's my kind of people. All right. Another vote for me never to add background music to the vids. Fair enough. Maybe if I'd picked a Billy Joel song. I mean, because no one can complain about a Billy Joel song. I'm sorry. It's not possible. Maybe some of his newer stuff. But I mean, the 70s stuff, forget about it. Okay. Here's a good question. John Lane, can you suggest some ETFs as a starting point for creating a 3, 4, 5 fund portfolio in a taxable account? Retiring next year and I'm in the 12% tax bracket. Yeah. Well, let me show you a resource. So the starting point would be, I'll give you 2 resources. If you Google 3 fund portfolio, and I'll pull this up on my screen, you'll find at the top of the search results this Bogleheads page. Let me take the comment down. And so this is the 3 fund, but it gives you the ETFs that you can use. They both mutual fund versions, which is what you're seeing here. Even gives thrift savings plans for those that are part of the TSP. And then down here, these are some ETF portfolios. They're all low-cost index funds. So that's one resource. Now, I would certainly think about asset location. I know you're 12% tax bracket, so that's worth considering. But if you have retirement accounts, you might have, like, for example, bonds in a traditional retirement account. But in any event, I think to answer your question, this is a good resource. And then the other one I want to show you, I think I may have shown you guys this. Hopefully I've got it here. Here it is. So this is a great website. It doesn't look like much, does it? Altruist Financial Advisor. So I don't know the person behind this site, but he's a registered investment advisor. He manages money. He's actually quite inexpensive, but only if you have a lot of money. I mean, because there's a minimum, and so I think it's like 20 grand a year, so something like that. But depending on how much money you have, he could be this. Again, I don't know a thing about him, but he's a low cost again for the right amount of assets under management. And from what I can tell, sort of a low cost index fund kind of person. But the thing I wanted to show you, I think it's this DFA versus Vanguard. Yeah. So what he's got here, again, this is just his opinion. So obviously do your own due diligence, but he's got the asset class. I don't know how well you can see that. The asset class here. And then what he thinks is the best fund for that asset class. And he's comparing DFA, Dimensional Fund Advisors, with Vanguard. And he gives a little analysis. And he's got, everything here: large cap value, tax managed large cap, small cap momentum. Not applicable, not applicable. I like that. Foreign developed market small cap. He bold faces the ones he likes, and then again gives some analysis, or for some of them he has some discussion. Really good resource. So yeah. The other thing is, I think Paul Merriman's has a similar Paul Merriman favorite ETFs. I know he does this. Oh, best in class. Here we go. Is this it? Oh yeah, here we go. So this would be another source. We all know Paul. He was on the show a while back. Best in class portfolios, March interim update, yada, yada, yada. And then you get down here, and for his kind of, this is for his ultimate buy and hold portfolio, but obviously you could follow your own, say, whatever, 4, 5, 6 fund portfolio, and obviously take advantage of this information. Again, just his opinion, an opinion I value, but we always got to think for ourselves, right? Anyway, that's a pretty good resource. I mean, you guys got your money's worth right there. We could just shut the show down. Sounded like I was going to say something else, didn't it? Okay. I love the comments about that direct indexing video. Noreen, yeah, she can't stand it. Then Tom says, messing up is okay. Appreciate it. And then Jeff says, just keep it real. I like it. But Josh, he liked the direct indexing video. The one thing I kind of, well, regret's too strong. Direct indexing video, I think I had a lot of really good content. I mean, I'm more convinced than ever that direct indexing is not for most people. That it's a way for brokers to offer something that most people don't need, but they're going to get some fee out of it. I don't say that in like some sort of evil kind of thing, but once you go down that path, you end up with a portfolio that you can't really pull out of the direct indexing. You're kind of stuck because, I mean, they start with 100, let's say 100 securities. If you're sort of tracking the S&P 500, I think Fidelity uses 100. I think Wealthfront uses 100. They have another one that tracks the whole market that's more like 600. So it'd be even worse. But then you start tax loss harvesting. So they're going to sell some, buy some others, and they might not sell the whole position, part of it. You end up with, hundreds of securities you can, and they have built-in gains. You're kind of stuck with it now and stuck with the fee. The one exception from that I think where it might make sense is if you plan to donate. And I put all this in the video. Anyway, I kind of regret that, the music was so distracting. Okay. So there's a well-known YouTuber named Ali Abdul, right? Like 3 million followers. I took an editing course. Now most of it had nothing to do with music, but he uses background music, and that's why I tried it. But yeah, it's not going to happen again. I have not completed. I haven't done anything, if I'm being honest, Greg, on DODLX. I don't even remember it. Did we talk about it? Oh, the Global Bond Fund. I like Dodge and Cox. I don't have any of their funds. Let's see what it's doing. I also, by the way, I generally don't think, I don't feel a strong need to have international bonds in my portfolio. I'm not suggesting that I think it's a mistake to have them. Vanguard sort of standard portfolios, like with the Freedom Funds, have an allocation to international bonds. I've just, felt for the purposes that I hold bonds, which is mainly, the security, well, except for this year. I don't need to get creative with my bond portfolio. But I will leave it up and take a look at it. So Steve wants to know, in the rising interest rate environment, are T-bills a good investment for spare cash? I think so. It's funny, well, not funny, but I invested in some T-bills 3 or 4 weeks ago and was getting 6-month, and bought new issue. And I got a yield of about 3.2. Now the yield's like 3.8. So again, I won't lose money in the sense that I'll hold them to maturity and I'll get 3.2, right? Plus my investment back. But the value goes down, at least for a while, when interest rates go up. So if I sold them now, I would sell at a loss. I don't know why I'm putting it in air quotes, because it would be a loss. I don't know if it would have to be. I could look it up, but then I would reinvest it at the higher yield. But the net result of all of that, when my initial 6-month period was up, would be that I earned 3.2%. It's like, so you kind of get stuck in that. And that's just the way it is, right? And if we could buy one today at 3.8, and in a month, or even who knows what the Fed's going to do. Some are saying they might raise the Fed funds rate 100 basis points, but who knows? For all we know, 6-month T-bills will be trading at 4% or more. That's just the way it is. I mean, you can't really do anything about that as far as I'm concerned. Having said all of that, yeah, I think they're pretty good. I would at this point probably pick them over the current SaveBetter options. And the reason I mentioned SaveBetter as opposed to like any other bank is because they have the highest, that I'm aware of, the highest savings account and money market account rates, 2.75, right? So I would rather have a 6-month T-bill at 3.8. They do have the no penalty CD. It's currently 3% at Ponce Bank. Not Ponce. It's actually a community bank, which I think, if you want to, community banks give back into the community. There's actually it's a designation. I don't know what you have to do to qualify, but I think that's a good thing. But it's 3%, so it's no penalty. So, you can take it out anytime you want. Well, after 7 days. But a 6-month T-bill at 3.8, I kind of like that. I am expecting many of these rates to go up even later this week, if not then early next week after the Fed moves. So they could be more competitive. But like if I were investing today, right now, cash, personally, I'd put it in T-bills. Vinyl says he actually had a 50th reunion of his 6th grade graduation. I never graduated from 6th grade. We didn't have a 6th grade graduation. I feel cheated. Anyway, our teacher actually came to the event. That's nice. So in 6th grade, we were changing classes because we had elementary went up to 5th grade. My 5th grade teacher was Mr. Bricker. He was tough. But in sixth grade, we switched from class to class, and I can't name a single sixth grade teacher. Anyway. Yeah, I have this freakish memory from when I was young. But what's weird is I remember my first grade, second grade, fourth grade, fifth grade. I don't remember my third grade teacher's name. Kind of weird. I don't know what happened in third grade. But I have very detailed memories. I remember in first grade we were all standing up to do some sort of exercise, and when we were done, one of my classmates went up to the teacher right before lunch and told on me, said that I had erased the chalkboard. So she called me up. I guess the teacher had written something on the chalkboard. Robbie, did you erase the chalkboard? No. And she goes, would you turn around? So I turned around. Apparently there's chalk all over my back because I had rubbed up against the chalkboard and not realized it. She kept me in for recess. Teachers, I don't know. I have seen that the euro and the US dollar are basically on par right now. I saw that in some context. I forget what it was. Not that I have a demand for euros. All right. So this is an interesting question from Omar. How long after the Fed rate increases do bonds start to go up again? Is it after they stay flat for a while? Is it not until the decline again? Well, so the Fed fund rate doesn't have, in my view anyway, I'm not that I'm a Fed expert at all, a direct relationship to bond yields. Bond yields are going to be driven by the market's view of inflation. Obviously, if inflation is very much tied to what the Fed is doing, so I guess in some way it's all connected. But I think the bond market right now is already priced with a certain expectation of what the Fed will do. But that, sometimes something can spook the bond market, and the prices can go up or down, the yields go the opposite direction. There's the question of how much they'll raise rates. One thing, I suppose there is this connection. Let's just say that the Fed raised rates 125 basis points, which no one is expecting. What that could communicate to the market is, the Fed thinks inflation is far worse than we thought. That could change bond yields. But again, it's more a question of the market's expectation of inflation, I think. But again, I'm not an expert. Actually, our next door neighbor was an economist at the Fed. I should ask him. He's retired. Okay. So Kalowish asks, what do you think of using a taxable account to save for renovation that's 7 years away? I think it's a great idea. The question is, what are you going to put your money in? Now, I'm guessing that's a ticker, maybe a Fidelity ticker. Let's see. Oh, it's the Total Market Index Fund, FSKAX. So the issue is, 7 years out, I wouldn't necessarily have a problem with it, but at some point you're going to have to start backing off, in my view. Maybe I'll answer it with what I would do, because I can't tell you what to do. I would start to move a lot of it to less volatile, bonds, fixed income, shorter duration kind of investments as we got closer to needing the money. And that could start, I generally don't want money in the market that I'm going to need in the next 5 years. Maybe you could push it a little bit and say the next 3, but you're going to have to, or I would at some point, sort of let off the gas pedal, so to speak, or be willing to delay your renovation, right? I guess part of it could be based on how much flexibility you have in terms of timing. So that's how I think about that. But you could put it in some sort of, Wellesley, depending on what you wanted, 60-40, 40-60, Vanguard Life Strategy Fund. The thing you got to be careful with is you can't just willy-nilly start jumping from investment to investment, because you're going to trigger capital gains. Of course, you're going to end up paying capital gains anyway, assuming you have any. We hope you do, once you need the money, but you need to think about taxes. But like, I probably wouldn't just throw it in a savings account for 7 years. That's a pretty long time. All right. So I don't know what this is in response to, duration times 2 minus 1, but I know that formula, right? That's sort of your break even, right? In a rising rate environment with a fund that is linked to, well, duration really, but maturity. Yeah, that's how long it takes you to earn your money back, to basically earn the yield that existed when you invested in the fund. I think that's right. But the pan will tell me if I've got it wrong. Okay. My mom says, thank you for mentioning the books. Love you, Mom. You're welcome. They're great books. Why wouldn't I mention them? I can't wait till my granddaughter's old enough to enjoy them. All right. What's this about? Randy wants to know, poll, U of Michigan versus OSU. I'm not sure what the poll would ask. I guess, who do you want? Do you want Ohio State to win, or would you prefer University of Michigan to lose? I guess those would be the two options I would put in the poll. All right. That's an interesting question, Patrick. They're not. It says, here's his question. Why are article links in your newsletters redirected through the Rob Berger site instead of a direct link? They're not. I put the direct link to the article. So there shouldn't be, like last week, I don't think I had any links at all to robberger.com, I don't think. But anyway, yeah, I linked directly. I don't know. I don't know when the newsletter goes out, does it link through my email provider? I'm not sure, but that still wouldn't be robberger.com. Sometimes, yeah, I guess you could say from a online marketing perspective, some people will redirect them through their site so they can track it, but you can track clicks and everything. Not that I look at this data very often. Just through your email. I use Active Campaign. It's just the name of the service. I will sometimes look at it just to see what you guys like and don't like based on the clicks, but I don't even do that very often. By the way, I'm not cheap. I don't like Discord. I don't know that I'm going to do a community, but if I do, it will not be on Discord. That I can tell you. I don't know. I'm not a fan of Discord either. All right. Man, a lot of banter tonight. Well, this is interesting from R. Hasten. The Treasury sends out an email every Sunday morning with every bill and bond daily rates for the year. I didn't know that. Thanks for sharing that. So a question from Bob. How does yield factor into bond performance? Intermediate Treasury yielding more than 3.5, but down year to date 10%. So it's a great question. And this would be true whether it's an individual bond or bond fund. Yield, when price and yield move in opposite directions, right? So as the price of a bond goes down, its yield goes up, and that's effectively what's happened this year, right? Because of the economic conditions, the price of bonds have gone down, the yields have gone up. And so if you're looking at, it could be an individual bond, but let's just think about B and D, some sort of total bond fund, you'll see it at a loss. In fact, we can look it up. We'll just use BND as an example. Let's look at the pain. Let's feel it. How bad has it been? I don't even know. I'm going to guess it's off, I don't know, 12%. Let's see. Here it is. Performance. Yeah, 12.32% right there, right? So how is that calculated? Well, that is a combination of the decline in price of the bonds, but then also it is the fund is earning interest. So that, let me pull the comment down. There we go. So you're earning interest, and because price has gone down, yield has gone up, and as the fund is buying and selling new bonds, because it's doing that, this fund has more than 10,000 bonds. We can actually look at the number, by the way. Go to portfolio. Let's see here. I think it's down here. 17,000 bonds. Hello. What will happen over time is the fall in price will create a big hole in your portfolio, right? We all know that. Eventually, over time, the increased yield that you're getting, as compared to, say, what we got a year ago or 6 months ago, will slowly start to fill that hole back up. And the question is, all right, well, how long does it take to fill that hole back up? Well, that's the formula that the pan showed us, right? Duration times 2 minus 1, which in this case, the duration is around 7 years. Now, one thing I need to point out, though, is we're kind of assuming a lump sum investment. You know, if you're saving for retirement and you've got some bond exposure, you're adding to it, let's say, every paycheck in your 401k or whatever. And so that changes, you know, you're buying at lower and lower prices, your dollar cost averaging, right? So that's no different than, you know, you're doing that with stocks this year as well. And they're cheaper today than they were, whatever, 9 months ago at the start of the year. Anyway, that's my basic understanding. I hope that answers your question. All right. G says that they are listening on an iPad and hear no buzz. Good. We don't want buzz. But Noreen hears a rattle. I don't know. Are you still hearing the rattle? Do you hear it when you go like this? Just kidding. It's a joke. I don't know, Noreen. I got no answers. Of course, you left that comment like 30 minutes ago, so maybe it's better. So here's the thing. I'll just go back to this briefly. So I could set up like a Facebook group. The problem is, for me, is if I'm going to monitor it and be a part of it, it's a lot of work. I did that when I had the Door Roller Money podcast back in the day. I started a Facebook group. It was free. I could do that. You guys, I could certainly jump in as much as I can. But that might be helpful to all of you. I mean, because what I found for the last one was, people answered the questions with great information even before I saw the question. And that's great. Works for me. MB wants to, Rob, show us a close-up of the newspaper clipping where you're getting ready to dunk on the guy. So number one, I've never been able to dunk a basketball. When I was in college, I could grab a hold of the rim. That's about as close as I got, but I could never palm the basketball. So it was ugly. This is actually my sister. How well you can see that. She's the one with the basketball guard. That was many years ago when she was in high school. And then she played for junior college. Very good basketball player. Funny story. She was home from college, I think. We went down to middle school. This is like on a Saturday, and we're shooting hoops, and a couple of guys, kind of stroll in, and they want to do 2-on-2. So sure, why not? So basically, I go into the middle, I get the ball, pass it out to my sister, who is a point guard at a JUCO, and she drains the 18-footer, And we do this 2 or 3 or 4 times. And then one guy's yelling at the other guy, Garter, and they're trying to, yeah, we won that. I didn't do anything. I just caught the ball, threw it back to my sister, let her do all the work. Okay. So I don't own, so the question is, how did I pick AOR? I don't own AOR anymore. I moved it to a different fund. But it just had the right asset. When you're trying to do basically an asset allocation kind of fund, you're looking at fees. I actually found a fund that I like better that's a little cheaper. AOR, I think it was 15 basis points. I mean, AOR is, I think, a reasonable fund. This is an iShare fund. I think it's 15. Yeah, it's 15 basis points. I think the one I ended up with was a Vanguard mutual fund that's like 7 or 8 basis points. But it was basically, what asset allocation did I need in that particular account so that my overall asset allocation was what I wanted? And, I was, it's like close enough is, it's horseshoes, hand grenades, and asset allocation. I don't need it to be precisely perfect, All right. I'm just catching up to where you told me you heard the applause. Man, I'll go a little later tonight to the extent anyone wants to stay on, since I took up a lot of time at the beginning. Jay, I am not going to get a soundboard like Kramer. All right. I'm looking for questions. Great comments back and forth. Here's one. I did a video on this. What do you think the IBond yield will be for the next term? I don't remember exactly what I said in the video. I said probably around 6%. If I had to guess, it'll be between 6 and 7%. So we've got one more month. Here's the thing. The last reading, it was basically, the overall CPI was basically it's basically flat. But if you look under the hood, a lot of craziness was going on. Food and shelter up a lot. But then, as we know, gas prices had come down, so energy was down a lot. And so they sort of canceled each other out and gave us a fairly, benign month-to-month reading. Obviously, annually, it was still a big number and a little bit more than people expected. It came in at 8.3, I think. If energy prices now don't do anything crazy, we could see a bump in inflation, not necessarily the overall number, but the month-to-month. Because if food and housing and other components continue at a pretty strong pace, and you don't have that fall in energy prices to sort of offset it, I could see, again, I'm just guessing, but that's why I kind of think 6 to 7%. I personally would be surprised if it's over 7, but that's my best guess. By the way, and people have emailed me about this, apparently, you can buy IBonds as a gift. And the way it works is you buy it in your account. And I think they actually did they call it a gift box? Treasury Direct gift. Yeah, gift box. Those crazy government folks. So here's the idea. So let's say next year, particularly, let's say you've got a significant other and you both plan to buy IBond. You've already bought this year, you plan to buy next year. So the way I understand, I've not done this yet, but I do plan on doing it. And if I run into trouble, I'll let you know. I can buy an IBond now. I've already bought mine for the year, but I can buy another one as a gift, and it can stay in my account and it starts earning interest. My wife can do the same thing. And then next year, rather than buying IBonds, then I can gift her the one IBond and she can gift me the other. Or depending on interest rates, maybe we just buy next year. I don't know how long it can stay in the gift box. These are things I need to look into. But it may be that we don't gift the IBonds until 2024. But they'll get 6 months of the 9.62%, even if I buy them in October. And then they'll get 6 months of whatever the new rate is in November. So that's something to consider. Again, I've not done it. Everyone says you can. All the cool kids are doing it. But, you know, my mom used to tell me, just because all the other kids are jumping off a bridge. I don't know that my mom actually ever said that to me. Maybe she didn't. I don't remember. Steve wants to know how Betterment is going. I actually pulled it up. It's going fine. I'm basically even. You know, it was up for a while. Of course, it's been down. I've added a little to it. So those that don't know, this is we invest all of our credit card rewards, and I have more to put in here. But I think my performance is like I've lost like $11. So it's basically even. I like Betterment. I like the platform. I mean, you know, there's a fee, so you got to keep that in mind. But if I were going to pick a robo-advisor, I'd probably pick this one. The other one I would consider is Wealthfront. I like Wealthfront as well. Okay. Joe wants to know if I'm ever going to record upstairs again, or am I banished to the basement forever? Well, I'm banished to the basement at least for the foreseeable future, but I like it down here. So I'm happy. I wonder if I could plug in, if I could show you what it looks like. I think I've done this before. Of course, I'm going to pull a wire out and everything's just going to shut down. Let me see if I can do this. Will that work? No, I've got the wrong cord. No, I can't do it. And I'll break something trying. Maybe next week I'll have my iPhone ready and I can show you what my setup looks like, what I'm looking at. But basically I got a computer here, big monitor, two lights. They're called key lights. So you can see my hands there. My camera in front of me, in front of it is a teleprompter, which I only really use for interviews because I can put the person's, I can put them up in front of me so that I'm looking at them. It's probably obvious to everyone that I don't read a transcript with any of this. And I've got a keyboard. I won't try to pick it up. I'll unplug something. It'll be ugly. Anyway, Joe, yeah, probably going to stay down here. Are you unhappy with this? I could, I've kind of got things back here, just stuff. I would like to maybe spruce it up a little bit. We'll see. Well, how important is the underlying? So this is, Greg wants to know VIOO versus SFSNX. How important is the underlying index, S&P small cap 600 versus the Russell, I guess ROFI? I forget what that stands for. I was just looking at that today. What is ROFI? The ROFI US, and it's probably not how you, what's that stand for? It's ROFI.com. Their website doesn't say. How can it not say? In any event, doesn't really matter. The way I would look at this, the index can matter. Depends what you're trying to accomplish. So let's take a look at these two funds. So we'll first look at the VIOO, which is an S&P small cap 600 index. Here it is. And what I like to look at is a portfolio. So this has got very small companies. That's what that blue dot in the bottom portion of the third, bottom row of the tic tac board, right? We can actually look at like market cap. So that's pretty small, $2 billion average. I know $2 billion is a lot. Let me take the comment down. Yeah, there we go. But that's pretty small. And it's not a value fund. It's sort of, it's tilted a little towards value, but it's definitely a blend. And then you didn't give me a ticker for, let me see if I can find one. IJR, which is an iShares fund. Let's see if it tracks. It must. I don't know why I say it must. Here's what I'm looking at. No, this is small cap 600. Huh. Why did Google send me to this one? I need a ticker. Oh, wait a minute. Maybe this will tell me. Let me see if I can find it. Now you have me curious. FNDA. Schwab Fundamental U.S. Small Company ETF. I think this tracks it. Let me just make sure. The way I don't know if Morningstar. Yeah, it does. So let me show you. So we're on the Schwab fund or website. Yeah, total return of the Russell U.S. Small Company. So then if we come back here, we can look at the portfolio. And so it's very similar, right around that sort of blend value, but it's slightly larger. And we can actually look at the market cap. So it's $3 billion. So my instinct tells me there's not much difference at all. I suppose some could say, well, I want to tilt even more to small cap if I can. So I'll go with the S&P small cap 600, right? But, which one is going to outperform? I mean, we all know we can't know that. And so they're very similar on the sort of value growth. One has, they're both small cap. One has an average size of 2 billion, the other 3 billion. So they're very close. I would think either decision would generally be reasonable, depending on what you were trying to achieve. That's my take on it. Now I just need to figure out what RAFI stands for and if they actually say RAFI, or if I'm just making a complete fool of myself. Or both. I don't know. Is there an app that you can back test like Portfolio Visualizer that goes to 1929? Not that I'm aware of, like Portfolio Visualizer. If anyone else is aware of them, of such a thing, let me know. I will show you this that we've seen before, but it's not the same thing. So FICalc.app allows you to test various withdrawal strategies, and you can put in your stock bond allocation. And I mention it because this, you can use all the available historical data. That's what this check mark is right here. Let me take the comment down. And it will test it all the way back to 1871. All right. If you uncheck it, it starts in 1926. But again, it's designed to show you how retirement withdrawals will play out, which may not be what you're actually looking for. So, yeah. One thing I noticed, I was using this tool today, and something I noticed, I'm going to show you this. So it's a 60-40 portfolio, $1 million portfolio, 40,000 a year. And so remember, Bill Bengen said this would survive 30 years for any year. So this site must use slightly different data for its asset classes, because it's showing these years in 1960, the red and colored in red is they run out of money. And so if we look at 1964, for example, it lasts 29 years, but it runs out of money. And then what I found interesting about this was that if I asked you, you're going to retire. And I said, okay, do you want to retire? Let's say you retire January 1. That first year of retirement, would you prefer to have double-digit inflation and a stock market crash, or really low inflation and the stock market's up? And here you'd probably say, Rob, is this a trick question? What am I missing? Here's the thing. 1964, as you can see, wasn't the worst year to retire. I just know that from the data, not from this chart, but it was not a great year. Really, the mid to late 60s were all rough. That's really what gives us the 4% rule. Really, 66 or 68 were kind of the real stinkers. But 64 wasn't great either. And here's the interesting thing. If we go to, we look at historical returns. This is from NYU. And I know it's a truckload of data. You could basically ignore it. I'll just show you what I want to show you here. Here's 1964. I know you probably can't see that. I can make it a little bigger maybe. There we go. S&P, including dividends, returned almost 16.5%. And inflation was a whopping 0.97%. What a beautiful year to retire, right? Except that we know that 64 wasn't a great year to retire. It wasn't because 64 was the problem. It's because of, you had to live through the 70s and early 80s with pretty, bad stock returns overall and really terrible inflation. On the other hand, look at 1974. If you retired then in January of 2004, 30 years later, you'd have taken all your withdrawals and you'd have over 1.1 million left in your account after 30 years. If we look at 1974, though, look at this. Stocks down almost 26%, and inflation, and this number changes a little bit depending on where you look at it, 12.34%. Now, I've seen other numbers that put it at 11%, but the point is, 74 was brutal. The reason, though, it turned out better than, say, a decade earlier was because you were already through some amount of the bad year. 73 was another one, but you didn't have as far to go to get to the end of the light at the end of the tunnel, which would basically be 1983. Whereas if you retired in the mid to late 60s, you had to trudge through 12 years of bad economic conditions. You retired in 74, that year was bad, but you didn't have as far to go to clear the dark forest. All of which is to say, it's almost impossible to determine whether you're going to, what your 30-year, and I'm just using that as sort of a traditional retirement range is, what it's going to look like based on the first year. If we have a decade of badness with inflation and stock returns, my hunch would be that 2022 wouldn't be the worst year to retire. The worst year to retire, I would guess, has probably already happened. We just don't know it yet, like 2020 or 2019. That's what makes it all so much fun. Okay. Corey, would you ever recommend rolling an IRA into a 401k that permits it, that has low fees? Sure. And you can, for the sake of simplicity. So yeah, the IRA would probably have to be a rollover IRA, meaning it only contains money that you've rolled over, say, from a 401k, as opposed to contributions. But yeah, if it's low fees, for simplicity, there are other reasons too. For example, maybe you want to do a backdoor Roth, and you've got, if you've got a bunch in a traditional IRA, they have that rule where you've got to sort of factor in all of your IRA, not just the one you want to convert, move it into a 401k, then you don't have to worry about it, right? So there's other reasons to roll an IRA into a 401k, but I like simplicity. If you're happy with the investment options, yeah. Okay. What is next? Man. Ethan, I couldn't agree more. Uptown Girl is not my favorite. But scenes from an Italian restaurant. Now that's a classic. I always say Brinder and Eddie. Probably Brenda. Sounds like Brinder. They were the popular steady. I won't sing it. Okay. We used to go, the urban legend says that song was based in part on an Italian restaurant in the north end of Boston. Probably not true, but we used to go to the restaurant that supposedly that song was at least in part based on. I still find that unlikely. Florence's, great restaurant, but this was, 30 years ago. I don't even know if it's still there. Okay, so Gary says, I will retire in 2 years at the age of 60. I want to convert my 457B to a new Roth 457B. Do I have to wait 5 years to do withdrawals to avoid penalties? Is this just on earnings? I have to tell you, Gary, I don't know a thing about 457Bs. I always thought the 5-year. So 457B is like for state employees, right? See, maybe I'm completely wrong. Yeah, civil servants, municipal employees. But if you can convert so it's associated with an employer. So if you could convert, and I didn't know that you could convert. Yeah, the short answer, Gary, is I don't know. But I tell you how I'd find out if I were you. I'd call the administrator of my 457B plan. They'll tell you. But I always thought the 5-year rule applied to IRAs. I have never heard it applied to a 401k that I am aware of. I'm looking at the ceiling like the answer is going to be up there. I don't see the answer up there. All right, I think we have Adam, I just retired from teaching July 1. Congratulations. Thanks to your videos and newsletter links, I now self-manage my accounts. Looking forward to not seeing an advisor fee removed from my accounts in October. Well, congratulations to you. I'm actually working on a video, by the way, based on an email. If you've got your accounts in an advisor, you're thinking about going on your own, how do you do that? Like, what are the steps? Not how do you open a brokerage account, but like, how do you think through all of the issues of, taking this portfolio that your advisor has been managing for you and doing it on your own? I'm working on that. All right. All right. From Stephen, have you ever read The Safe Investor by Timothy McCarthy? I have not. I've not heard of it. The Safe Investor. Have you guys noticed this? When I Google something and go from a Google result page, I get this 404 all the time now on Amazon. It's probably just me. Whoops. Here it is. Got decent reviews. Anyway, I have not. I'll have to check it out. Single point of failure, healthcare expenses. And what would be a single point of failure today? Yeah, I've just not read the book. A single point of failure. Why would healthcare expenses? I guess the theory is like you could have health issues where the expenses were so great that by itself it could wreck your finances, I guess. I'm guessing that's the idea. That's a good question. You could certainly think of world events that could doom us all. We don't even have to be that creative, right? But in terms of just what could happen to a family or an individual, I don't know. Maybe I don't know. Not that I can think of off the top of my head, but maybe I'm just not being creative enough. All right. So Benny says, I found, referring to my direct indexing video, found it enlightening. Fidelity actually solicited me after considering it, and did not mention many of the points you made. So what I have found is that reps of some of the large brokers will make statements that I think a lot of people will accept at face value, but then upon closer scrutiny, there are issues with it. Like, for example, in that video, I pointed out to a Fidelity study that showed the value of direct indexing, but when you go to the fine print, you realize they're making assumptions, and I'm assuming their math is correct, and they can make whatever assumptions they want, but they're assumptions that really don't apply to the vast majority of us, and that leave out things like the eventual gains when you sell, assuming you sell some or all of a direct indexing portfolio. I've had it happen where someone at a big broker will, and I did a video on this, said, "Oh, well, this fund that's actively managed outperformed that index fund, and these were two balanced funds." But when you look under the hood, you realize their asset allocations are very different, so that you really can't compare them. I had one person tell me that their funds had outperformed, X percent of their funds had outperformed the index. But when you dug into the study, you realize that they only considered the funds. This was happened to be from Fidelity. And by the way, I love Fidelity. I think they're really good. But they were only considering Fidelity funds where the manager had stayed with that fund for, I don't know, 5 or 10 years. Okay. I mean, that's selection bias. It's like, picking the football teams where the quarterback has been there for 10 years. Yeah, well, there's a reason they're there for 10 years, because they're really good. And the teams tend to do better. Anyway, so it's really important to question everything, really think about what you're being told. By the way, do the same thing when you're watching this show. I shouldn't get any special treatment. And based on the comments I've been getting, I don't think I do get special treatment. Apparently, that's particularly true when it comes to background music. Sheesh. Okay. I don't know if this was a question for me, but it says you need to revisit the bucket strategy. So I don't know if this will be a video, but one person emailed me and asked, he said, given that both stocks and bonds are down, doesn't that make the case for the bucket strategy and having, whatever, 2-3 years of cash? And to me, the answer is no, it doesn't change anything. In any given year, we can look back and say, okay, if we'd have done this, it'd have been better. If we put all our money in REITs, we would have had the best outcome ever. This year, if we had all our money in cash, but I don't think we can judge, our approach to investing based on what happens in a single year. What's happened this year, it literally could be a once in a lifetime event. I mean, I think over the last 100 years, stocks as measured by the S&P 500 and bonds, say intermediate term, have only both been down a couple of times, 4 times, maybe 5. And if we were to end the year now where they're both down a fair, double digits, I don't think that's ever happened, right? Or I don't think it has. If it has, it's only happened once since 1926, but I don't think it's happened at all where they're both down double digits. Maybe it has once, but the point is, at least I don't think we can judge it based on that. And I want to show you something. I was doing this today as well. I'm looking at Portfolio Visualizer. I want to just use the Bogleheads 3 fund. So this is a 3 fund 80-20 portfolio. We'll just leave it like that. And then over here, I want to copy it. But what I'm going to do is put in cash. Where's cash? And let's imagine we've got $1 million. We're gonna withdraw a fixed amount. We'll call it $40,000 annually. Adjust for inflation. Your typical 4%. But here we're going to put 2 years in cash, which I'll say is 8%. Okay, and then and that's going to be a bucket. So we're going to then have our portfolio separate from that. So let's see here. This would be 46. This would be, is that right? 4. And then we need another 4. So 60% of 4, 2.4. So 27.6, right? And this is 18 point, is it 4? Yeah, I think I've done the math right. It's close enough. If we analyze these two portfolios, this goes back to 1987. So that's still a long time, 35 years, right? You can see the outcome is pretty significant, 7 million versus 6 million. Now I'm putting in assumptions. We could change the cash component to something else. We could, for example, let's do it this way. This will make the difference not as great. In fact, maybe it reduces it a lot. Let's try it this way. We'll make this 12. And then, so what we're doing here in portfolio 3, we've got the cash, but we're making it part of our bond fixed income portfolio. So it's still 50, 30, 20. It's just the 20 is broken down between 12% in total bond market, 8% in cash. So that'll bring it closer. Let's see what that looks like. Still $600,000 difference, but it's better. But my point to all of this is cash is a real drag on a portfolio over the long term. So to me, yeah, I know this year we'd all love to have been in cash, I suppose. But I just don't see that as I don't know how, I just don't think we can make investing decisions based on what, a very unusual set of circumstances that leads us to 1 year where stocks and bonds are both down. That's how I feel. All right. There's another and I've been working on, I've been doing a lot of reading on this, and I'll have some videos, but you think about Bill Bengen, his approach was to rebalance every year, right? So you basically have the same equity glide path in retirement. It doesn't change. Say it's 60-40 or 70-30, it stays that way. You rebalance every year. But there are other approaches. That's not the only option. Like one of them is, let's say you've got a 60-40 portfolio. One approach is spend all your bonds first. And at least according to the book, Living Off Your Money, which is around here somewhere, I think I might have taken it upstairs. His analysis says that you actually get a higher initial withdrawal rate spending the bonds first than if you just rebalanced every year like Bill Bengen. And it gets you through, if it's a 40% bond allocation, assuming roughly 4% a year, roughly gets you through 10 years, unless this is your first year and your bonds have gone to zero. Are you guys following all this? I don't know. I feel like I'm just stream of consciousness here. But the point is, you're going to get, we'll call it 10 years of spending just from your bond portfolio. So if the stocks are down, you just kind of ride it out. And if assuming a traditional retirement age, that's going to get you over a lot of the danger zone for sequence of returns risk. The downside to it is you're going to get higher and higher equity allocations. So you're going to be 75 sitting on 100% stocks, and that freaks a lot of people out. But when you back test it, it actually does okay. All right. That was an answer to no question at all, as far as I can tell. Callowich had a crush on their third grade teacher. I don't think I ever had a crush on any of my teachers. Not that I can remember. I don't know what that says about me. My favorite, though, one of my favorites was Mrs. Miller, fourth grade, because I never got into fights. I was just not a fighter. But I did get into a scuffle, we'll call it. And we got, I guess, detention, sort of. We had to help her after class, like for an hour. And I collected beer cans as a kid. Why? Because I grew up in Ohio. That's what we do. Tractor pulls, beer cans. And so she sent me out to her car to get into the trunk and get something for her. And in the trunk was a mint condition Foster Lager, which was a big deal for a fourth grader collecting beer cans. Let's see here. Oh, here it is. This is a newer version, though. See if I can pull the picture up. 2 for $7. Here it is. But this is the new can. This was steel. I mean, it was the real deal. And they're big, right? And I told her I collected beer cans, and she let me have it. I don't know if it wasn't full of beer. It was empty. So there's that. All right. Well, this is pretty cool. R. Hasten says, I have some very old IBonds, and they are currently paying over 12%. That would be because of the fixed rate. He's got a fixed rate above zero. That's when they had a real base rate. There you go. Nice. I know other people. I know some folks that have like $250,000 in IBonds dating back quite some time, and they're just making a fortune. Okay. What did I say about teachers? It says, watch that, Rob Berger. I'm a teacher. Did I say something? I don't remember. That comment was from like an hour ago. I must have said something. So this is from Dan. He says, regarding Social Security, the amount paid increases by cost of living adjustment, right? However, will the amount you get if you start in 2024 be increased by COLA in 2022? That's a good question. My first reaction was, of course it will be, but I don't know how that works actually in terms of the starting amount. Like, what you would get if you started this year versus next. Is the difference the same as the COLA adjustment? I don't actually know that. I shouldn't assume the answer to that is yes. It's a good question. Maybe someone else can help. All right. It's funny to see these comments from like 30 minutes ago. I don't even think you guys need me, really. You guys can just chat amongst yourselves. Maybe I'll step away for like a half hour. You guys are good. You guys are answering your own questions. Kelly wants to know if you do a gift IBond to a child through a custodial treasury direct account, how are the gains eventually taxed? I'm going to have to say I don't know. I mean, a bunch of issues are kind of coming to mind. Kitty tax is one. But if it's a custodial account, I assume it, but I don't know. It's a good question. I don't want to mislead you. That's a good Google question. How are IBonds taxed in a custodial account for a child? I don't know. Oh, according to this website, and I've never heard of it before, the child beneficiary technically owns the custodial account, not the custodian. Well, that makes sense. Thus, the child is the one who technically needs to pay taxes, but it's not as simple as it sounds. Yeah, finally, any unearned income the child makes in this account beyond $2,200 is taxed at the parent's or guardian's tax rate. This tax rule is known as the kitty tax. So I guess I wasn't, at least according to this website that I've never heard of, crazy to mention that. So it could be more complicated than you would like to think. So I don't really have a complete answer for you, Kelly. Sean wants to know, is he limited to the 10K? More or less, yes. This is for IBonds. You can invest another $5,000 as part of a tax refund. So Here's a good question. Jeff, do you agree with the basic idea of establishing an asset allocation of 110 minus your age? I do not. I think the whole rule of thumb, there's 100 minus your age, 110, 120. I just don't, that's just not how I think about it. At 70, I don't think, I should have, that a portfolio based on that kind of rule of thumb. I think it's more based on goals, risk tolerance, and that sort of thing. Own your age in bonds is, kind of another one. I guess that's 100 minus your age for the stock portion. Same thing, I guess. But yeah, I don't find those rules of thumb all that helpful. Well, Joe wants to know, what is your strategy for refilling your cash bucket? So a couple of things here. I don't follow the bucket strategy, number one. Number two, as I was doing all the work on the cash bucket a couple of years ago, I was expecting to be living off of our investments, but I'm generating enough income to meet our expenses, so I'm not taking money out. I can tell you that what I will do is basically sort of take money out on a quarterly basis. I'll keep some amount like for emergencies. I don't know what that will be when the time comes. But maybe 3 to 6 months, and I'll probably then refill things on a quarterly basis. Big Earn, early retirement now, that's not his name, it's his nickname, but he's very big on a monthly because he wants to keep as much cash working as possible. So all his analysis is done on a monthly drawdown of your investments. And that's certainly a reasonable approach, and I understand the logic behind it. I probably will stick to quarterly, it seems just easier to me. All right. Well, Jordan wants to know, how do you feel about keeping more than $250,000 in a single high yield savings account? I probably wouldn't, just because why? Open up a separate bank account. You got, or you could have like a no penalty CD and a high yield savings account, open up a different account at a different bank. I just don't see any reason to exceed the FDIC insurance limit. You could do, through Fidelity brokered, where they have more FDIC limits. Well, the FDIC limit isn't different, but they can structure the account in such a way that you can get higher protection. That's probably what I would do if I had that problem. Or I'd just buy T-bills. So I did a video on AVUV. I like it. I just, it doesn't have a lot of history. And it is an actively managed fund, sort of, kind of, it is. It's a small cap value. I like the fund. I would, and I've even considered investing in it. I haven't yet, but I did a video on it. It just doesn't have a lot of history, but I mean, so far it's done well. So Noreen, what should I do with an upcoming bonus? Put it in my IRA or cash savings? Well, it kind of depends on your goals, right? I mean, if you're saving it for retirement, I would think you'd just put it in the IRA, right? If you're going to need it sooner or use it for some other, I'd probably, so I guess here's what I would think. First of all, do you need to increase your cash savings? Do you have an adequate emergency fund, or do you need to beef that up? If you have an adequate emergency fund, then what's the reason for saving more cash? And maybe there's a good one. Maybe you've got some need for the cash coming up soon. You're going to take a trip around the world, whatever it might be. If it's for retirement, I mean, to me, an IRA is ideal. So that's kind of how I would think about it. I'm sure there are other factors one would consider based on your, do you have debt that you should pay down? That's always a question. Should you fund a health savings account? If you have high deductible policy, you may not, but these would be things that I'd be thinking about. By the way, I'm going to start doing some short, they call them YouTube shorts. It's like TikTok. I've done a few TikTok videos. I haven't really gotten into it. I don't know. Maybe I'll do more, but YouTube is rolling out a feature, and I don't have access to it yet. It's still experimental, but where I can pull up a comment on my phone that you all fine folks leave, like, Rob, that music is dreadful. And I can, I don't know, click a button and record a YouTube short, which I think is limited to 60 seconds. And I don't know how it's going to work, but I envision that the comment comes up on the screen and you guys can see it, whatever, and then I respond to it. I plan to do a lot of those. I don't know what a lot means, but I see a comment. It's maybe not the kind of thing where you need a 10-minute video, but it might be useful to have, a 60-second video. Answer the question. So why did I even bring that up? I don't know. All right. So here's a good question from BJJ Freak 82. Is it a good idea to invest in TIPS or total market bond fund for the long term? I'm about 5 years from retirement. I think they're both good. One could argue have a bit of both. TIPS are good if inflation turns out to be higher than the market expects. Total bond market fund is good if the inflation turns out to be lower than people expect. David Swinson, who passed away a couple of years ago, he ran the Yale Endowment. I've talked about his portfolio suggestions. I'm looking for his book, which I've got somewhere, but in any event, he kind of imagined having a bond portfolio that had sort of both in it, because you don't really know the direction of rates and inflation, rather than trying to predict it, have both. But I also think just a total bond fund is fine. That's generally what I do, along with my IBonds, which are relatively small amounts because you can only buy so much at a time. But yeah, I think, probably if someone were going to say, Rob, what's your best view on this? It would probably be own both of them. I don't at the moment, primarily for simplicity. Actually, that's not true. I do have some exposure to TIPS, but it's not significant. But when you add the IBonds in, it's not insignificant either. Of course, just because that's what I do doesn't mean what you should do. Hey, Noreen, Jeff here is giving you an assignment. Noreen can set up the Facebook page. Look, Jeff, Noreen's working on figuring out where to put the bonus. One thing at a time. All right. Here's an interesting question. What is the effect of the yield curve inversion on precious metals? Well, I don't know if it really works this way, but one could argue that if we think a recession is coming with inflation, the gold bugs among us would say gold would be pretty good. Protect us, right? Hedge against inflation. The problem is the data just doesn't really support that. Just doesn't do that. Gold prices today, what are they? 1,600. I mean, let's see here. Yeah, I mean, they're down this year pretty substantially. So I'm just not a big fan. In fact, I get emails from people, from companies, gold companies, that want me to promote them on the channel. And so far I've turned them all down. It's not because if people want to invest in gold, I wouldn't rule out the possibility that I might put some money in gold, but it'd be more of a collectible kind of thing, I think, than anything else. But one company that reached out to me, I didn't pursue it. I just deleted the email. But I've bought from them, this is a long time ago, AppMex. They always treated me well. I don't know what their markups are. But I was more for collectible things, all of which I think I've now gotten rid of. I actually won from them. I was at a conference and they were giving away an ounce of gold. You just put your card in, and I won it. I won an ounce of gold. I've since sold it. And then in another conference, I won a free trip to London for my wife and I. We ended up taking the kids, a flat for free for a week. Pretty good. Let's see here. Oh, here's maybe the most important question of the day. What do you think about the Magnus cheating scandal? So Magnus Carlsen is the world chess champion, arguably the greatest chess player ever. And he was playing in an event in St. Louis, the Sinkfield Cup. Sinkfield is the name of the individual who, a very wealthy man, who basically provided the funds for the St. Louis Chess Club. I've been there. It's very fancy. There's a Chess Hall of Fame. He's also one of the founders of DFA. Yeah, see? There's a connection between chess and mutual funds. So yeah, he's got a lot of money. Anyway, the Sinkfield Cup is played every year, and it's a lot of fun. Well, if you're into chess, after that event, they have an event where like a bunch of players are playing each side of the board, and they make 5 moves and they switch. Sinkfield and his son play in it. Gary Kasparov is playing in it, former world champion. Anyway, that's not what you asked me. Magnus got beat by a 2,600 rated player. So it'd be like if LeBron James was playing one-on-one with like a decent college basketball player and lost. And he then the next day announced that or maybe it was that night, is withdrawing from the tournament. He's never done that before. And he didn't say why, but folks sort of quickly concluded that they felt that Hans Niemann, the opponent that beat him, that Magnus believed he cheated in some way. And cheating is a big issue within chess because the best computers can crush any chess player today, including Magnus. But Magnus didn't actually say he was cheating, and then it blew up on the internet. Hikaru Nakamura, who's a top 10 chess player in the world. I think he's top 10, and he streams on Twitch, and phenomenal chess player, particularly good at speed chess. Had a whole thing on his show about this whole cheating scandal. I don't think, unless something happened today, there's still no proof that Hans cheated. None, as far as I can tell. And they will actually run games through some computer analysis that can actually detect cheating if you're just playing out of your mind at like a 3,300 rated level or something. Something I've never been accused of, by the way. Not the cheating part, that's true as well, but playing like at a crazy high level. So I kind of think Magnus needs to say something, but so far he's not saying a word. He's also not going to defend the world championship. It's kind of a bummer. I don't know what's going on with him. Anyway. All right. That's our chess for the day. What time is it? It's almost 9 o'clock. There's still a lot of you watching. Don't you guys have anything better to do? I wouldn't have gone this long, but I don't think the Manning cast isn't on tonight, right? I don't think they come back till next week. Yeah, I don't think it's till next week. Yep. It's a shame. That's a lot of fun. Okay. I'll do a couple more. Then we'll call it a night. I'm tired. Paul says, is there any reason to choose new T-bills over secondary market ones? Sometimes the new ones can just be a little easier to buy, I think. But from an investment perspective, not that I'm aware of, if you buy in the secondary market, say you're looking for a 6-month, you can buy both T-bills, like maybe you buy, it was a 9-month, 3 months have passed, and the owner is selling it. So you get 6 months, right? And the yield will get adjusted based on the price to get it to whatever the 6-month yield is. Or, you could be buying a longer term treasury bond that's just 6 months away from maturity, right? But there could be some technical benefit one way or another, but not any that I'm aware of. I just found it very easy to buy new T-bills. So that's what I've done. So Ethan has a good question. Why all the yield chasing with cash? Because we're going to do a kitchen renovation, so I need the money. So we just got to park it somewhere. Yeah, that's it. I also have an emergency fund always. So here's the question from Dustin. Do I think the fixed rate will go up on IBonds? I really don't. My guess would be no. Given what the inflation rate is, and I would be surprised if it went up in November. Oh, this is from like an hour ago, but John says you can leave the IBonds in the gift box for multiple years. Good to know. Another person said the same thing, so it must be true. We have double confirmation. So Benny says, were you satisfied with the Fundrise's guest answer to your question on how the shares are valued? Not really. I mean, it was interesting. I really like Ben a lot. I think he's very knowledgeable on real estate investing, but he had trouble answering some sort of, I think, basic questions about how Fundrise itself works. But whenever you're dealing with non-traded assets, how they get valued are really, really important, because non-traded assets can often appear less volatile than, say, a publicly traded REIT, but maybe they're not actually. And so, we depend on how they're valued. Now, by the way, you do a BND, a lot of their bonds are not publicly traded that they own. I mean, I know the fund is, but they're using valuation services as well. So it's not as if Fundrise is doing something that no one else does. I just, right now, I don't see a reason for me to invest in like an Open Door Capital, a Fundrise. If I were going to do something like that, I'd probably invest in farmland. But I'm just not sure that the fees and the tax consequences. Of course, you could always do it in like a self-directed IRA, but I don't want to bother with that. So, at least at the moment, for me, I don't really see that as something I'm going to do. But it doesn't mean it's a bad thing or that you shouldn't. I'm just telling you what I'm doing or not doing. I guess this is about the whole basement comment. I'm in the basement. Basement is fine. We're just old and don't like change. Yeah. This is funny, Ethan. Boy, more with the music stuff. Number one, clean up the basement, which what you see is, I think, fairly orderly. But if you could see over there, add a house plant. Yeah, it's something I have to take care of. Can it be artificial? Think about music again, maybe. That's number 257. So TC, yes, you can buy an iBond and put it in your gift box and then give it away at some point in the future to your wife or someone else. Is there a limit on the gift box? I don't know. Limit on iBond purchases. You guys are asking tough questions. As a gift, 10,000. How much in IBonds can I buy as a gift? The purchase amount of a gift bond counts towards the annual limit of the recipient, not the giver. So in a calendar year, you can buy up to $10,000 in electric bonds and up to $5,000 in paper bonds for each person you buy for. That's from Treasury Direct. So I don't know this, but do you have to identify the recipient at the time you buy it? Again, I've never done this. Here's the website, by the way. This is what I was reading. This really just generates another question. I do that from time to time. Sean. So we were in Greece right before COVID. No, the year before. Yeah. For our 30th anniversary. And we were in, I forget, but it's where they've got this cut through the rock where the ships go through. I forget what city it was. But there was a bridge, and the rock that goes straight down for like 15 miles. I'm sure that's how far it goes down. And we were on the bridge, and people were bungee jumping off. I couldn't even like stand at the edge and watch. All right. The funny thing is, like, I can get on a roof and not be bothered, and I'm far more likely to die falling off a roof than I am on a bridge that's got a railing that's high. All right. I really need to call it a night because I am going to turn on Monday Night Football. I don't even know who's playing. So Lopa asks, how do dividend growth ETF stocks, mutual funds used to fight inflation? Are asset-backed security bonds better than corporate bonds? Well, those are some interesting questions. So everything that I have read says that longer term stocks are a better fight inflation, are a good hedge. I don't know if that's the right word, but are a good response to inflation in the long term. Short term, as we've seen, inflation rates go up, bonds go down, but that longer term stocks are a good way to deal with inflation. Are asset-backed security bonds better than corporate bonds? Better. I don't know. I don't know that I think about it that way. First of all, in corporate bonds, you have to, I assume you mean investment grade as opposed to junk bonds, but maybe you don't. I don't know what the yield spreads are between asset-backed securities. I assume mainly mortgage-backed bonds. So I don't know. Housing market, there's some stress in the housing market right now. So that could send yields higher. I don't know. Let's see here. I'm trying to find something that may be useful. Do they have a date on this? So this is from Schwab, but there's no date on it. What's wrong with you, Schwab? Where's it got to be a date on here? Well, we know it was sometime after July. So yields are up on mortgage-backed securities. That's what MBS is. Oh, right here. Boop. But Fed policy poses a risk because rates are going to go up, right? But this really doesn't compare them to corporates that I can see. But they have been up. The yields have been up. But the yields have been up on everything. Yeah, I don't know. I don't have an opinion on comparing mortgage-backed securities to corporate bonds. Maybe I should, but I don't. Ethan must be a tax guy or very knowledgeable. I don't know if this is correct, but I'll show it to everyone. Gift tax exclusion is 16. That I know is correct. No limit between spouses. You know, the thing about gift tax too, am I correct that if you gave someone more than 16,000, there's still a lifetime exclusion. So isn't it just an informational return until you exceed the lifetime exemption, which is quite large? Anyway. I think I'm going to call it a night. I'm just flipping through here. It's amazing. I'm going to go all the way to the bottom. Here we go from Jeff. Buy low, sell high. I like it. Okay, we'll end with this one from Jeff. Would rolling over an old work 401k to a rollover IRA cause tax issues while doing a backdoor Roth? Yes. Assuming, we're talking about a traditional IRA, rollover IRA, because the IRS sort of looks at all of your traditional IRAs. You may be rolling over one of them over here that's got after-tax dollars in it, maybe because you funded it and you can't take a deduction. You plan to just do a backdoor Roth. But the amount that will be taxable is a function of all of your traditional IRAs and just a ratio between after-tax and pre-tax. So yeah, if you want to do backdoor Roths, you want to keep your money out of other traditional IRAs that are pre-tax, right? Such as what would happen if you rolled a 401k over to a traditional rollover IRA. Ethan must be a tax guy. Yes, but it counts against your estate tax exclusion. Best strategy is not to file the 709 for the average Joe. So don't file the 709. I don't know what a 709 is. It's got to be an IRS form. IRS form 709. United States gift tax return. Man, Ethan, you are good. All right, gang. I'm tired. Thanks for hanging in there tonight. Thanks for joining the live stream, even though I included background music in my last video. Much appreciated. Thank you for your input on the mics. Thank you for your input on some sort of community thing, which I don't even know if I'm going to pursue anyway, but what else do I have to thank you guys for? Oh, remember to email me if you're going to be at the Boglehead conference. I'd like to at least get an idea if anyone's going to be there. And if so, if you want to get dinner Wednesday night, that would be fun. So there you go. Hope you have a great week. And until next time, remember, the best thing money can buy is financial freedom.